Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting. Anna Myers is on our program today, and she is a diabolical genius, extremely data-driven, and is just a wonderful person to have on our program when we are in a time where we need people like her to give us information based on facts, reality, and historical data to help us make decisions for our real estate investments. Really love this interview. So Anna works for Grocapitus. She's the Chief Operating Officer. And one of the reasons that I wanted her in the program is we recently interviewed Neil Bawa, her partner, boss. They have a fantastic relationship. Neil and Anna have over $1 billion assets under management. They have just destroyed collecting data and being able to use that information wisely. There's probably no other fund that is set up like theirs. There are people that wait all year for their January report. Neil Bawa is considered the mad scientist of multifamily. So just great to have this company on. Let me tell you about Anna. So Anna is a third generation commercial real estate entrepreneur who applies her 25 plus years of experience in technology and business to finding, analyzing, acquiring, and asset managing commercial properties in key markets across the US. As a tech geek and systems architect, Anna is known as the chief plate spinner at Grocapitus. She collaborates with her business partner, Neil Bawa, to implement systems and processes that strive for efficiency and scalability both within the company as well as throughout their portfolio. As the head of acquisitions for the company, Anna teaches underwriting and deal analysis for Multifamily U in quarterly boot camps. Multifamily U is an apartment investing education company owned by the principal Neil Bawa. Also via Multifamily U, Anna hosts weekly webinar events featuring top speakers in real estate. As the head of asset management for the Grocapitus portfolio, Anna brings a data-driven approach to track and insert optimizations to the properties to help drive property performance and investor returns. Anna regularly speaks on podcasts, webinars, and at conferences covering topics including asset management, deal analysis, real estate trends, opportunity zones, how to 1031 into multifamily syndication, and much more. Because real estate is an occupation that can create abundant opportunity in lifestyle, Anna is also a digital nomad living and working remotely from beautiful locations all over the US, currently residing on the East Coast in Boca Raton, Florida. Second longest introduction, Neil Bawa was the first. Anyways, big fan. I take a lot of time to get the best guests possible on this show. Please listen to some of the previous folks we've had on. Gene Trowbridge, who is the king of keeping you legal when you are syndicating a real estate deal. We've done 3 or 4 interviews with him. I could mention a ton. We just had an economist on talking about interest rates. Omar Khan, who runs a very successful private equity fund. Just tons of guests. I don't want to go on and on. I'd like you to listen to this interview and check out our website, rei.mba. I love you guys. Enjoy the interview. Cheers. All right, guys, you just heard a little bit of the intro for Anna Myers. Anna, thank you for being here.
You're welcome. I'm loving being here already. Learning new technology and everything. Yeah.
Yeah. And we got through the hurdle. So we're here. I'm excited. I had your colleague Neil Bawa on, and he is the mad scientist of multifamily. And behind every man, there's a very strong lady. And I guess that's you, because you've been keeping him running and ensuring that the enterprise is where it is. You've been very, very successful.
Thank you.
So
Thank you. Yes, it's been a great partnership.
yeah, tell me about some of the beginning, and share some of the how large you guys have gotten in what I think is a short period of time.
Sure. So I met Neil when he was teaching a multifamily boot camp in February of 2018. And at that time, I was trying to transition from my previous career into full-time into commercial real estate, and took his class. And so started following him and, getting more involved with him. He asked me to start volunteering for him, doing some data analysis. And I loved that because I thought what a great teacher he is. So he started out more of a mentor. And then pretty quickly, once he saw the type of worker, the type of person I was, he basically asked me to join his new company, Grocapitus. It was in August of 2018 that we kind of launched. And so we are now in November of 2022. And we have, it's hard to keep count, but it's about 4,800 units, mostly multifamily. We have a little bit of flex industrial. We have some storage, which we have since exited from, and a lot of multifamily, both new construction as well as value add.
It's
very key markets through the U.S.
Tremendous growth, and that's from 2018 through COVID to now.
COVID, yeah,
and into a recession. We're all kind of in a funny spot.
Very funny spot. Well, it's not very funny. Sorry. Yeah. It's interesting. It's
peculiar. Yeah. I'm like,
peculiar. That's a better word.
My law school degree comes in like handy once in a while. But I'm an analytical person. You're an analytical person, and that is what you base. I mean, your career on, and you have to be right, or at least more right than not right. How do you do that right now, managing such a large portfolio with very smart people? You still have people wondering and probably calling your office like, "Hey, how are we gonna make it through this?"
Yeah, well, as usual, it all comes down to the numbers. So when we are managing our existing project, whether it's new construction or existing project that's already built and has tenants in it, or a value add, you're always going back to the numbers that you projected. So you always have to go back to your business plan and say, what were we supposed to be doing now? And if anyone knows Neil Bawa, he's a master at watching the horizon and understanding how the upcoming changes in the market, what's the economy doing, how is it impacting things, and then projecting what is it that we need to keep an eye on. And so then we're always doing what if scenarios. And sometimes those things never come to pass, but we'll see a recession on the horizon, and months ahead of time, we start planning to be like, well, what are we going to do? What is our what if scenarios if this is going to happen? So we're always working in the background on these things. And then as things, if those things actually come to pass, we believe in being very transparent with our investors and letting them know, here's the situation, here's what we're doing to remedy it, here's what we're doing here, here's what we're doing there. And, this is what we are projecting is going to happen as a result. So we also believe it's very, very important to show your data to your investors, keep them up to date, keep them on board. There can be times, during COVID, there was times that we had to stop distributing because we didn't know. No one knew what was going to happen during COVID. They evictions were there was a moratorium going on. We didn't know if tenants could pay their rent, and thus if we could pay our mortgage. So that was a good example of a time where, we had to say, hey, we've got to stop distributions until we see how this is going to ride out. And then eventually, as each property had its own set of challenges. They're located in different counties and states across the U.S. But we made it through. And all of those projects ended up being very successful exits. The ones that we exited during that time, or the ones we held, are doing very well. But it's all about being super, super on it. I remember some of my friends and family members during COVID, their work got to be much less because, things were shut down, all this. I, on the other hand, as the asset manager hat that I was wearing, I was so overloaded because we were having to do so much data and trying to keep ahead of things. And part of that was taking care of our tenants, making sure that we're researching in every county what are all the available services that we can get for our tenants to help them pay rent. They can't leave, so let's see what we can do to help them pay rent. And because we're in different places, we had to do that in each state, each county, each city, and come up with all of this. So data isn't just about numbers, learning how to research and stuff. And I will tell you that, while Neil and I are master researchers, what we believe in is having an army of researchers. So one of the powers of our company and the efficiencies is that we use virtual assistants. So we have about 60% of our staff is actually offshore, most of that located in the Philippines. And we have lots of systems and processes in place for how we run that team. And so, that type of research that is very intensive and takes a long time, we're able to assign it off to people that from $1 per hour is not costing a lot to the project. Because you don't want to do all this research and then suddenly build a project hundreds and hundreds of dollars to save a few,
Right.
So there's a big trade-off that happens. So, and again, that goes back to Neil and my backgrounds in technology, because as technologists, we were very used to outsourcing and using people from different countries all over the place. Well, we both just carried that into Grocapitus. So we basically have a real estate company that we run as a technology company, is the way we like to look at it.
I love it. And something that has made you very successful in sharing the data is everybody waits for Neil's report and your report for January. I'm right?
Yeah,
So,
it's pretty remarkable, the data. Just so everybody knows, that the real estate trends is what it's called. And that's the first time I saw Neil speak. He was delivering real estate trends at a conference in Oakland. And I was so impressed. That's why I went to his boot camp and was like, this guy, the data, this is crazy. So some people are like, well, when's it going to be in January? January 1st, January again. Well, we wait until the reports come out at the end of January.
Sure.
So we have to, because our data is based on third-party knowledge. I mean, we're not going around creating data. We're basically taking the data that's public data from third-party experts and assimilating it and then projecting what are these things could mean and making suggestions. Neil likes to put his neck on the line to pick markets. But I have to say, our portfolio is based on those picks. And our portfolio has done very, very well through COVID. Going into this recession, I still feel like we're in the right markets at the right time. And, so we're definitely, eating our dog food. Is that the term?
No,
Yeah.
it's great. It's cool too, I mean, you don't know that many organizations that have a report that people are waiting for. And also investors really look forward to, there's, some fluffy stuff like newsletters and some minor things, but that's some pretty comprehensive work. Let's get into that. So the world is changing. That's the most politically correct way I could say it. And what I love about our podcast is we have folks that are just starting to invest or haven't and are going to. And then there's also some veterans. We have some great news information that we amalgamate on our website. So real trends, what's going on? Your organization are you guys purchasing? What are you doing with your assets? Are you, sitting back? Are you guys getting ahead of a curve that's coming? Can you share some of it?
Sure. So as everyone knows, in this time frame, again, it's November 2022, things have changed very, very rapidly. So at the beginning of 2022, we still had very low cap rates. Everybody, all those real estate investors were dancing in the street,
right.
counting our dollars.
Yeah, Mardi Gras.
Mardi Gras. And then the Fed started hiking interest rates, and at such a crazy rate, of course, cap rates were affected. And then debt is so volatile right now that it's a very difficult environment to operate in.
Right.
So we have, of course, we have value add as well as new construction, and construction has been facing its own set of challenges with supply chain shortages, increase in costs, labor challenges. So both sides are facing their own unique set of challenges. So as we've gone into the end of the year, I think it was about August, we launched the Grow Value Add Multifamily Income Fund, because we knew that we wanted to, come back into value add in a big way. Once the interest rates started going up, what happened on the value add side is things started getting more reasonable, because value add has been so crazy high. We stopped buying for a good year. We purchased, I think, one in January of 2022 with since then, we've just been waiting on the sideline. You go into contract on that like in October because it takes a while to close.
Sure.
The prices were nuts. The cap rates were like, who is going to pay that? You're not going to cash flow on that, right?
Right.
And so we were waiting on the sidelines. So once prices started coming down, we jumped back in. So we started the Grow Value Family Income Fund so that we could buy not just one property, but several properties. And that spreads the investor's risk. You'll be in multiple markets across different things. So we got one under contract, and we actually just closed on that one. And we were hoping to get 2 or 3 at the end of the year. But with this debt, we had to say, no, we're going to have to pause for a little bit. So the good thing is we've got money in the fund. So in Feb, which is when we believe that, debt might start to stabilize a little bit, be a little less volatile, and prices will continue to come down. So we think that Feb will be the great time to start getting things under contract again. And we've got dry powder to go after those. So that's on the value add side in terms of acquisition. We're penciled down at this time on that. We're looking at markets like we always do to understand how different markets are impacted. Some of the frothiest markets are the ones that we are looking at we might see the most declines in because they went up so high.
Right.
So it only makes sense if you have a market that's increased, 25% in rent increases over a year, which nobody would have thought is possible. That's just complete insanity. That some of those markets or home prices are the same thing. And we might have seen 24% increase in rent and 48% increase in home prices. That's not sustainable. So now those markets, Phoenix, Austin, some of those markets are Boise, they're coming down fastest, but that's because they went up, so much to begin with. And then we're looking at some of the other markets. So people are saying, where should I buy now? If I have to buy now, where should I buy? And, one of the things we're saying is if you have to buy now, buy in some of the less frothy markets. They're less sexy, they're not your, but they're less risky. So they're going to be a little bit more stable for this next period. So be careful about where you buy, because if you buy in a place that's still coming down, you could end up in the wrong, upside down there. Now, in terms of new construction, because we are also developers, we develop townhomes. We're very, very much in the build to rent game. So we do build multifamily garden style apartments, but our big thing in 2022 going forward is townhomes and fourplex communities that are known as build to rent. So it's a fantastic asset. It is the hottest new asset in multifamily. It has a ton of capital coming into it. So we're looking at cap rates that are equal to multifamily and could be better because the institutional money is so interested in build to rent. It's kind of their capital kind of flooding the market. And that's what you want on the other side.
Right.
You love institutional investors to come and scoop you up once you're all built and pretty and fully stabilized, have your bow on. So in terms of new construction, what we're doing now, of course, we're continuing to build. We had a bunch of land in contract over the past, 9 months. Land you're in contract for a very long time because the due diligence period to understand, zoning, permitting, entitlement, potential issues on the land, that takes a while.
Right.
So I will say out of the 3 properties that we were under contract with, the land, we dropped one of them. First came back and said to them we want a 25% discount because land's going down, and that was a little too steep for them, which was fine. And then the other 2 we actually have gone ahead with, remodeled those, got a little bit of a discount, and continued with them. So so land is a good thing, but land is still going down. So land is the leading indicator for purchasing. The first thing to drop, and then you see multifamily, and eventually you'll see single family homes start to drop. So we're looking to scoop up land in 2023 because it'll start bottoming out. So I think 2023 is going to be a great buying year for us. And right now we're really focused, I say we're penciled down for a couple of months on our acquisitions, but that gives us an opportunity to really focus on our existing portfolio and making sure everything is ship shape on our current assets as we end out the year, because we can't ignore those. And we're remodeling everything with looking at debt, looking at what's happening. Rent increases are starting to now not decrease, but they're starting to flatten. So we need to remodel things so we know where we are. So that's our focus through the end of 2022.
So eloquent. I love hearing you. You said a couple things that maybe not everybody knows, and I'm like trying
Sure.
to tee you up for some good answers. What's dry powder? Pretend I don't know. And
Okay.
then you started another fund to be able to take advantage of the market, and you said spreading the risk across a bunch of assets. So that's not like a typical fund where it's like one, big $50 million property or
Right.
some other different type. So can you answer?
Sure.
Uh,
Sure.
yeah,
So, many of our, and within our portfolio, most of our projects have been a single property fund, which we call a syndication. So technically, I guess people can call it a single property fund because multiple investors are putting their money together as the limited partners on the deal for that asset. Now, when you create a fund that's a fund with multiple properties in it, investors are going in and they're investing $100,000 and there will be three properties in that fund. Their money is spread across those three properties. So maybe one of them is going to do, around pro forma, maybe a little bit less. Another one's going to be a home run, and then the other one's going to exceed just a little bit. Your risk is spread across those three profiles, which is a really good thing going into a recession because no one can tell you for sure. Even though we study the markets, no one can tell you absolutely for sure which market is going to do the absolute best. What are the next challenges we're going to be facing? I mean, this 2020 decade is going to come down for generations as
yeah,
like the woe baby. Like this decade is it's just
yeah.
nuts, right?
Well, they're gonna be like, how did they do it? How did they
Yeah,
survive
yeah,
this?
and they're going to say so many things changed as a result of the 2020s. So we are humble about that, and so we're using our data to pick the best assets in the best neighborhoods of the best markets in the best states, and the fund is a great thing because it lets people again have their money invested in multiple assets and income coming in according to those different things. What if there's an eviction moratorium for some reason that happens in one state, right?
Right.
And we're in three states, right? Well, you're only that one asset is potentially impacted, assuming you have people that should be evicted that aren't able to pay rent, but we can't evict them. So again, and that would be in a normal world. Normally, you don't have a nationwide eviction moratorium.
Right, right,
let's
right,
let's
right.
understand that
Thank
doesn't
God.
happen. Normally, you have localized events that happen. It could be a weather event or something that impacts a specific state. A tornado. I mean, there's all kinds. Almost every location has weather scenarios. So when we have this fund, we now have closed on one project, one property within that fund. We're seeking the other two. We could get as many as 5 projects according to our legal docs. We can buy as many as 5, but we're
That's great.
thinking now we might want to stop around 3. If there's more opportunity next year, we might go to 4 or more.
Yeah.
So when I'm talking about dry powder, I'm saying we've already purchased the one. We have more money that's come into the fund because people love the fund because they can get the tax depreciation in 2022, which is still the 100% bonus depreciation. So a lot of people looking for that, and they want to put their money where they can get that depreciation. And then next year they'll get more depreciation because those other assets will be bringing more depreciation. The dry powder means we've got money in the bank right now, which we're going to be using to buy the other assets that we're going to be acquiring next year.
Thank you. Thank you. Thank you. So that's a lot we got a few more minutes, and this is so good. I wish we had more, but you're really doing a full roundabout on how to be able to function in this type of environment, make sure that you're going to be okay, and you're waiting to purchase properties, which is way better than hearing we're not going to purchase anything for a
No,
long
we're
time.
ready. Yeah, we're ready.
And
On the land side too, right? Because it's not just acquisitions of existing buildings. We're also very eagerly looking to acquire more land to develop.
yeah, and that's a really cool thing about this. Blood on the streets is the other term that everybody's saying in real
Yeah.
estate, and that's only because there is ability to be able to purchase and value add. Very cool. So crystal ball, open ended. Tell me anything that you can help with somebody who's looking at real estate or owns or is a veteran or is just scared about what's going on.
Sure. So again, we look at data a lot. Neil spends a lot of time speculating about interest rates. He reads so many different sources. I think a lot of people are trying to say, where are interest rates going? And when is it going to be a good time to buy again? So our current thoughts are that as many people say that the Fed's going to raise again in December. And then depending on how inflation responds, could raise again in January. But we're seeing a trend where the interest rates overall are going to continue to increase and then start decreasing very slowly. We don't expect them to go down very quickly. At one time we did. Now we're speculating more of a slow meandering going down, starting in mid to late Q1, and it's going to take a while. So we're projecting that the recession is going to actually occur about Q2 of next year. And as the interest rates go down, that if you're bullish, that's a good time for you to be looking at buying multifamily. Now, multifamily prices, they tend to stay ahead because they're cap rate based. So cap rates adjust much quicker than single family. Single family, that the owner of the house goes, I'm not going to sell until I get this price. Right. And they might be completely unreasonable. But cap rates are like, that's the market science telling you what your values, what your property's worth. So multifamily, if you're looking to buy, late Q1, early Q2 of next year as the recession starts, if you're bullish, if you're bearish and you might want to wait towards the end of the recession, which we're thinking is going to be about a 6-month time frame, so towards the end of next year. Now, single family homes are still going to be going down. So it's not going to be the bottom for single family homes, we don't think, for another, maybe 12 months. And then as the interest rates start to pick back to really hit their bottom, that's when you want to start buying single family homes. Once we get back to where the Fed rate is about 2.25, that's where they want to kind of keep it equal. Right now, they're about 4.75, so they've got to come down quite a ways. And then that would be kind of a normalized interest rate. We're not likely to see, 2% interest and that type of thing. Don't wait for that.
Yeah.
You're hoping for another pandemic to hit the world, and none of us want that. So,
something wrong with you.
Yeah. So, when a Fed rate goes under 3, once the Fed rate goes under 3, that's when you would want to start buying single family homes, because your interest rates are going to be getting, and that's again, if you're bullish, you want to start buying the single family homes. Then we do think that, that the interest rates will even out, and bearish, you can wait a few more months. But it's the end and the beginning of a new cycle. So Let's be excited about that.
Yeah.
It's been 12 years and we're at the cycle has finished. Everything has its time. It's the world, turning, and we just need to look at where our opportunities are and count our chickens.
I love hearing you say that. Last question. So, Neil, I gotta ask about Neil. How is it to work with a guy like that? He's like, this isn't a compliment right now, but he's like kind of Elon-y with like how far ahead he sees with things. You guys don't turn on a dime that quickly, but just wondering how it is for you guys to work together.
Well, I think it's pretty great. I consider myself to be a very fortunate person that my business partner is Neil Bawa. I kind of wonder sometimes what in the world I did right to land in this seat. But yeah, you got to keep running fast to keep up with him. I think I have to keep, you have to stay sharp. You have to stay nimble. We're a very quick organization. We're always looking forward. We're always looking backwards. So that's the way that I have to operate. And that's the way that really everybody on the team has to operate. So we're kind of like, an armed forces type unit that's moving around and responding to things. So we all know that we could be going down the road thinking that this is like, hey, we're going to do this and this project. And then as something happens to that project, if some due diligence comes up that gives us pause, we don't have any problem with just stopping and walking away from it. And I think that the best thing about Neil and myself, and one of the things that we really share, is our focus on investors. It's always about, is this the right thing for our investors? And so if we reach something with our due diligence where we're like, we don't like this level of risk and we wouldn't want our investors to be here, we have no problem saying, there's been 50,000 put in this already. We've invested, 300 hours or 1,000 hours in this. We're like, nope, not doing it.
Move on.
Next, move on. And you have to be ready to do that. You have to accept that this is the world we live in. That's the cost of doing business. But it's so much learning along the way. I will say that it's pretty awesome being a student. I'm always a student of Neil Bawa because he's just an amazing mentor.
That's awesome. Love it all. How do I invest in your fund? And people always want to People like to talk to people nowadays, and people pick up the phone, which is cool. But
Well,
how does somebody get into your fund? How do they join your movement?
awesome. Well, there's two things. The fund, if you want to invest in that, because we still have openings and we will have just a large fund, is grocapitus.com/grow fund. GROFUND, not GROW, GROFUND. So grocapitus.com/grow fund. And then you'll get to our landing page and see all the information, the recording. You can also make an appointment from there with our investor relations and get in deep about Grow Fund. And then the other thing that I definitely encourage people to do is to get engaged with our sister site, our education. It's a free education site, multifamilyu.com. Now it's multifamily, the word, the letter U.com. And weekly or at least 3 times a month, we have free webinars. There was a really awesome one just the other day, Ask Me Anything with Neil Bawa and I. So Neil does, probably about 10 or more webinars per year. Yeah. They're all fresh content. When you come to Neil's webinar, it is not like, oh, I've heard 3 other syndicators do the same content. No, it's like crazy far out stuff that you're like, mine is blown.
Didn't think of that. Yeah.
Like, when does he sleep?
Yeah.
That's what I always wonder.
He's talking about humpback whales relating to
commercial real estate and how it's, I mean, it's really far out stuff, but it's we have such a great team for the research we do. For our design team is bar none. I mean, everybody tells us our investor webinars are the best. And so definitely encourage you to come. We also have guests that we bring on that I host. We have lots of, lawyers, syndication lawyers, CPAs, just content that's relevant for investors that are interested in commercial real estate. You may learn about new things like build to rent. It's all free. So, come on, get into our network and come join us and learn and ask some questions and get involved.
It's awesome. I talked about, obviously I had Neil on the show and we talked a bit then, but everything's in the show notes and great. I encourage you to check it out, everybody. But Anna, you're wonderful. Thank you so much for the time.
Thank you. I really enjoyed meeting you and being here with you.
Yeah, definitely. We'll have a transcript if you don't want to hear our voices. There is a video on YouTube. We're all over the place, iTunes, Spotify, Stitcher, and we'll have some fun. Thank you. Anna, thank you.
Thank you.
All right. Cheers. Take care.